Hello friends, welcome to CEC Live Lectures. Dear friends, today in this session we are going to talk on in our series on behavioral finance. Friends, you know that in our recent past we have conducted numerous sessions under this series and you have grabbed maximum knowledge through this session too. Friends, your feedbacks are important for us and your feedbacks elaboratively has shown us that how much you are gaining through the series. Friends, today in this session under the series we are going to talk on a risk attitude, and for the discussion on the topic we have with us in our studios Dr. Divya Verma Ghakkar. Dr. Divya Verma Ghakkar, we would like to tell you all, is a prolific professor. She is assistant professor in School of Management Studies, Guru Gobind Singh IP University. Friends, Dr. Ghakkar has immense experience and she always makes efforts so that the student community is benefited as a whole. We know that you might have lots of questions while listening to the session, and if you wish to call us and ask questions, then feel free to talk to us through our toll-free number. Our toll-free number is 1800-110-430. I repeat, our number is 1800-110-430. Dear friends, your questions are welcome. You are just requested to call in the last 10 minutes of the lecture only, so that first you could have a deep insight into today's session, and yes, of course, in the last 10 minutes we promise to give answers to your questions. Now we would like to welcome our guest, Dr. Divya Verma Ghakkar, once again. Hello ma'am.
Thank you so much, Radhika. Dear friends, under the series of behavioral finance, today we'll talk about risk attitude. All of us face risk in our day-to-day lives. Risk is uncertainty of what will happen or not happen in future. And in our routine life, we come across risk in various ways. Each individual has different capacity to take risk. That is the ability to take risk, as well as each one of us has different attitude towards risk. How much risk one would take in a particular situation depends upon various aspects. So what are these aspects? We are going to discuss about it. We'll also discuss about that how risk has been defined in classical finance, in standard finance theories, and how risk has been defined in the behavioral finance theories. So that is what will be the focus of today's lecture. As discussed, that we all face uncertain situations in our day-to-day life. For example, reaching to office on time, there is uncertainty whether we'll reach on time or not. A student who is preparing for his exams, he has the uncertainty that whether he'll qualify with good marks or not. So there is an uncertainty. A person who is appearing for a job interview, he has uncertainty that whether he will succeed in the job interview or not. Again, when we are investing our money in the financial assets, we have certain return expectation in mind, and then we would like to invest our money in certain type of instruments. Now these instruments can be classified as, let's say, risk-free instruments, medium risk instruments, and high risk instruments. So there are risk-free instruments where we would like to save our money or invest our money, for example, in fixed deposits, in government securities, treasury bills, or Kisan Vikas Patra, or national savings certificates, and the like. So those people who don't want to take risk invest their money in risk-free instruments. Then there are people who are ready to take little bit more risk. They invest their money in debt instruments of companies like debentures, bonds of government, and other corporates, then mutual funds. And then there are another set of individuals who have a high risk taking capability as well as attitude towards taking risks. So those people, they will invest in equity market, in derivative instruments, in real estate sector. So each one of us has some investment goals. How do we invest our money based on our risk attitude, based on our ability to take risk? That is what we are going to discuss about in this lecture today. So talking about risk, as we all understand, is the uncertainty. Now this uncertainty will lead to success or failure. Now when the risk which is positive, right, when there are avenues available which are positive in nature, which leads to success, So, any unmanaged risk we can say leads to the failure. So, if we understand that what are the options available, under those options we try to manage those options in a way that we are able to achieve success. So, that means we have covered the risk. But if we are not able to manage our available alternatives in a way that it leads to success, that means it is unmanaged risk. So, any unmanaged risk leads to failure. So, basically this whole in our day to day life, all decision making which we do, we try to reduce this unmanaged risk or the unmanaged uncertainties which we have, so that we end up achieving success rather than achieving failure. Now, how risk has been defined in various ways. Risk is defined as variation or disparity between the expected returns and actual returns. Risk can be positive or negative depending upon the behavior of the market, what is the intuition of the investor, experience of investor and his knowledge. Evan and Wren 2009, risk refers to uncertainty about the severity of events and consequences of an activity with respect to something that humans value. Risk is equal to consequence multiplied with probability of occurrence. Kalpan and Garrick 1981 explained risk as follows. Risk is equal to uncertainty plus damage. Emiger and Kim defined risk on the following equation. Risk is equal to danger plus opportunity. So, basically the opportunities and threats. So, any given option will give us opportunities as well as threats. How these opportunities which are positive outcomes and threats which are negative outcomes, they lead to creation of risk, or they lead to having risk in terms of achievement of some objective. That is what how risk has been defined. To incur risk associated with investment, investors receive higher value in return. This can be seen as premium or return one will get by taking more risk. As we all know, higher the risk, higher the return. Now, there are various types of risk. So, one type of risk has been defined in various ways, like interest rate risk. Interest rate risk arises whenever we invest in some investment venue and we get a certain rate of interest, but later on with the fluctuations in the market situation, the rate of interest increases or decreases. This is known as interest rate risk. Another type of risk is business risk. Business risk arises related to the operations of the business. So, in case there is a strike in a company, there are some operational competitive things related to a company which can lead to creation of risk, that is business risk. So, if we are going to lose our money, if we are going to lose some contract, that is known as business risk. Then there is credit risk. Credit risk is related to the credit worthiness of the issuer. If a issuer of a securities goes bankrupt or refuses to make payment, then there can be default risk. So, if we are investing our money or lending our money to somebody and we are not sure that whether that person will be able to pay back us the money, that reflects the credit risk. Taxability risk. The taxes, they keep on changing from time to time. So, if there is a change in taxation rate from time to time, then taxability risk arises. Another type of risk is call risk, which is associated with the bond holders, which can be called before the maturity. It usually happens when the interest rate falls. So, if a call option is called before maturity, it is call risk. Inflationary risk is also an important risk which each one of us face. It is the purchasing power risk. When prices of various commodities increases over time, so the purchasing power of the investor goes down and the value of money depreciate, which leads to the inflationary risk. Next is the liquidity risk. Liquidity risk arises when we want to convert our asset into cash. So, there are chances that while converting our asset into cash, we do not get the same amount of money, or we do not get it as quickly as possible. So, that is the liquidity risk. Market risk is another popular risk which all of us see in our routine life. It is also known as systematic risk. It is affected by the market conditions that in case we diversify our portfolio, still that risk will exist, because market risk is related to for example, global economic conditions or conditions of the economy, how GDP is changing, how interest rates are being changed, and because of that, if there is increase or decrease in the prices of the securities in which we have invested, that relates to the market risk. Next one is the reinvestment risk. Reinvestment risk is similar to liquidity risk. If we want to reinvest our money by liquidating from one investment instrument to another instrument, then in case we are not able to get the same amount of money, or we are not able to liquidate the same amount of money at maturity, then it is known as reinvestment risk. There are political, social and legislative risk, which are related to unfavorable government policies which can affect companies or individuals in our day-to-day lives. There is currency or exchange rate risk. All of us know that in this global economy, we have to deal in various currencies, importers, exporters, people investing money in one country or another country. They all face this type of risk, the exchange rate risk, which is reduction or increase or decrease in the prices of other currency with respect to our own home currency. Then risk has been defined by the standard finance or the classical finance researchers in a different way as compared to the behavioral finance researchers. So we are going to first talk about the standard finance view of risk. According to Shah 1997, individual preferences and attitude of an individual toward risk can be of three types. So risk has been defined as in three categories: risk averse, risk neutral and risk seeker. Standard finance assumes that risk is unidirectional. It is objective in nature, it can be quantified, it can be measured, and higher the risk, higher the return. The more risk you take, the more is the expected return, or if you expect more returns, then you will have to take more risk, and it can be evaluated, it can be measured, and it can be we can ascertain that what is the actual return as compared to the expected return, where is the gap, how much risk we have to take. So all of these things can be quantified, can be objectively defined. According to standard finance, there can be either an upside risk or a downside risk. If we feel that things will go negative or things will be unfavorable to us, that is known as a downside risk. But when we feel that things can go positive, the uncertain events which are going to happen, they can be positive, then it is known as an upside risk, which will benefit our project or the objective in hand. So the upside risk, like earning higher returns as compared to what we expected, so this indicates success, or a downside risk where we are getting returns which is lower than the expected, which is which is a cause of concern for all of us. In standard finance, we say that risk is measurable, risk is quantifiable, and risk can be measured through the instruments like standard deviation tools. We can calculate the beta coefficient, variances, skewness, kurtosis, mean absolute deviation. So these are the things which we can use for calculation of risk. Standard finance, as we all understand, assumes that man is a rational man. Rational decision making takes place by the investor, and riskier investment will provide you higher returns as compared to the low risk. So if you take low risk, you will get low return. Higher the risk, higher the return, which is also known as risk return trade-off. So there are two important theories which explain risk return relationship, which includes modern portfolio theory, which was given by Markowitz, and capital asset pricing model by Sharpe. The capital asset pricing model explains the behavior of financial security prices and help us evaluate the impact of possible security investment on the portfolio risk and its return. They have classified risk under various categories. Now, how this Kappa model has tried to evaluate risk? In the capital asset pricing model, there's an equation for calculating the expected return on an investment security, and the formula goes as that expected return can be calculated as risk-free rate of return plus beta multiplied with risk-free rate of return minus market risk. So, it is also known as market risk premium. How much extra premium the investor is expecting by taking that extra amount of risk, and that beta calculates the risk related to that individual security. So, risk-free rate of return plus beta multiplied with market risk premium will give you an expected return which the investor is ready to expect by investment in a particular investment avenue. So, by investing money in that avenue, if he is getting that amount of return, he will invest his money. Otherwise, he will be dissatisfied that this is the amount of risk I have taken, but I have not got the related returns. So, that is what the Kappa model suggests. So, Kappa model very categorically defines risk as beta, and it is quantifiable. It is the beta is defined as that with 1% or with one change in the market return, how much the individual investment instrument is changing. It is changing by 1%, more than 1%, less than 1%. So, that is what beta defines. So, if the sign also matters, so if the market return is going up and your security return is also going up, so beta is positive. If market return is going up and your security return is going down, that means beta is negative. So, beta also reflects the systematic risk. Now, Kappa model defines risk into two categories: systematic risk and unsystematic risk. Systematic risk is uncontrollable risk, and unsystematic risk is also known as controllable risk. Systematic risk is related to the market and it cannot be diversified. It is denoted by beta, and it shows changes in the stock return with respect to changes in the market return. Even if so, it is affected by various market related factors like government policies, GDP of the country, the inflation, the interest rate, and all such factors that can affect the overall market. So, if market is having depression or a boom phase, so this market risk, so it is something which is uncontrollable. Even if we diversify our portfolio, the systematic risk cannot be controlled. Another part of the risk is the unsystematic risk. This unsystematic risk is also known as controllable risk. This unsystematic risk is the one which is very specific to the business organization. It is very specific to that individual security, and it can be avoided by portfolio diversification. What do you mean by portfolio diversification? Portfolio diversification is that when you are investing your, let's say 100 rupees, so you do not put all your 100 rupees in one type of investment instrument, but you invest your money in various alternatives depending upon the risk each alternative is providing and the time frame each alternative is providing, so that if one alternative gives you losses, another alternative gives you profits, so your overall portfolio or your overall average returns on your investment comes out to be positive. That is what portfolio diversification is. So, it is always recommended that you should invest your money in a way that not put all your money in one investment instrument, but diversify it or put it in such investment instruments which provide different investment, which have different risk classes. So, some money you should put in risk-free instruments, some money should be put in medium risk instruments, some money can be put in long-term investments like real estate or gold investment, which is very, very safe, and some money can be put into the risky investment. So, in case one market is down, another market is up, or returns you are getting from one market is positive or one instrument is positive and another one is negative, your overall average returns comes out to be positive. So, portfolio diversification has its own advantages, and that is why it is always recommended to have portfolio diversification. Now, this unsystematic risk is controllable and it is firm specific. So one company is doing good, is having less business risk as compared to another company which is having high business risk. So if you have invested money in both the companies, you will be able to get good average returns as compared to an investment wherein you have put all your money in one specific company, which is high risk company, or which has suddenly come up with some sort of business risk which you did not predicted initially. So all this can be avoided by so in that way it becomes controllable. So some things are controllable in terms of why it is known as controllable risk, because it can be controlled at the level of the management. So the top management of the company can try to control such type of business risk or operational risk which arise, or financial risk which is very firm specific. For example, if there is strike in a company, or you have to meet up certain targets, or you have to get a contract which is very lucrative or which will provide good opportunities for you. So companies or managers can always work towards it and try to control all such type of risk which can come. So that is how unsystematic risk is controllable risk, is firm specific, and as outsider of the company or as an investor also, we can try to minimize this unsystematic part of the risk in our investment by diversifying our portfolio. Now, behavioral finance also has defined risk in a different way. Victor Riccardi has defined behavioral finance, has defined risk under behavioral finance as an interdisciplinary field, developing theoretical basis, know-how and research methods from diverse decision-making sciences of psychology and behavioral economics. Behavioral finance deals with decision-making process of investors with respect to behavioral attributes of individuals. Under behavioral finance, we have talked about prospect theory, which was given by Kahneman and Tversky, which explains that people generally are risk averse, they are loss averse, and they are always more concerned about avoiding their losses rather than achieving gains. Behavioral finance refers to the concept of bounded rationality, in which an individual takes decisions by modifying the rational choice according to the limited knowledge he has, his cognitive factors and emotional factors. Therefore, behavioral finance scholars have a viewpoint that risk has got subjective component. So, the concept of bounded rationality was given by Herbert Simon, where he explains that it is the man is rational, but it is bounded rationality. That means under certain circumstances he will look at the rationality and try to achieve the maximum or the best possible solution at any point of time. So that is what is the principle which is being followed by the behavioral finance also, that people have a rational choice, but they also look at the cognitive factors and emotional factors. So that means risk is not something which is very objective, it has a subjective component. One can objectively define risk of various investment instruments through various mathematical models which are given, but still there is some subjective component in this risk which is related to the emotions, the attitude and the cognitive factors which affect the decision making of an investor from time to time. Subjective risk help in influencing in the perception of the investor and reaction of the individual, which affects their decision making. Behavioral finance considered that there is a perceived risk which is subjective aspect of risk. So in behavioral finance, rather than we talk about risk, we talk about perceived risk. How risk has been perceived by an individual, and it can vary from one person to another person. Helps in how it helps the perceived risk help in investment decision making, and which is much more than the objective aspect of risk. So basically, standard finance talks about rational human being, behavioral finance talks about irrational human being or human being guided by bounded rationality. Risk is objectively explained under standard finance. Under behavioral finance, risk is subjectively explained, or rather we talk about perceived risk and the perception and reaction of individuals and their risk attitude, their risk taking capability also defines that whether the risk which they are taking, it is high for me, low for you, or it is the risk which I see the perceived risk is higher, and it is something which I do not want to take or I do not want to carry out, rather than looking at risk from the objective perspective that it is 15% or 20%. So 15% can be more for me, 15% can be less for me, and more for somebody else. So that is how perceived risk is different from the objectively defined risk under the standard finance. Over to you.
With this note, thank you, ma'am. Thank you so very much for giving us this session where we discussed more and more on risk attitude. Friends, there is a lot more for you. You are just requested to be with us. Thank you. Hello friends, a warm welcome to you all once again in this session, and you all are aware that today we are talking on risk attitude, an important topic under behavioral finance. Friends, we would like to introduce to you once again that we have with us in our studios Dr. Divya Ghakkar, and Dr. Divya Verma Ghakkar is a prolific professor, and in our previous sessions too we have discovered and discussed a lot through her. Friends, we believe that today also you are discussing a lot and discovering a lot. She is a prolific professor who is teaching in School of Management Studies, Guru Gobind Singh, Indraprastha University. Friends, we believe that your queries should be resolved from time to time, and for that we have a provision for you, and the provision is you can call us in our live sessions and become a part of it, ask questions, and get instant feedback too. So friends, for contacting us, just note down our toll-free number. Our number is 1800110430. I repeat, our number is 1800110430. Now I would like to welcome our guest, our expert, Dr. Divya Verma once again. Hello ma'am, welcome back to the session.
Thank you so much. So carrying on our discussion on risk attitude. So till now we have discussed about that, risk is the uncertainty. It is unmanaged risk that creates problem for us, that defines that whether we'll succeed in our target or we'll fail in our target, and everybody tries to manage in their routine life the unmanaged risk or the uncertain part of the risk. Standard finance defines this risk as objective, and says that rational human being takes rational decisions, and there is risk can be objectively defined with the help of calculations like beta, standard deviation. We can measure this risk, whereas behavioral finance perspective of risk is perceived risk, and for every individual the amount of risk we are ready to take or the amount of risk we see related to any project can vary from person to person, because it is perceived risk, it is subjective risk that matters rather than the objectively defined risk. So taking this discussion a little further, the standard finance has defined risk as objectively measured. So there is Kappa model, there is Markowitz model, which is available for this. Apart from that, there are statistical techniques through which we can measure risk, like standard deviation and variance are two methods through which we can quantify the amount of risk which we are going to take up in any investment instrument. So standard deviation is the difference of the expected return vis-a-vis your actual return. So the difference of the two will define the standard deviation, and variance is the distribution of expected future cash flows. Apart from that, there is beta through which we can measure risk. Beta shows relative return in comparison with the market index return, and it is also a measure of volatility. Then there is alpha, which represents the value of an investment. It is the return which an investment earns, which is adjusted for market risk. A positive alpha means that a manager produced more return than expected return for the amount of risk he has taken. Skewness and kurtosis are also statistical method through which we can look for or we can identify how much is the risk. When a distribution has positive skewness, it is known as right side skewed, and when it has negative value, it is left side skewed curve. Negative skewness is an indicator of risk in an investment asset. Kurtosis also shows that whether a distribution is relatively flat or it is peaked as compared to the normal distribution, which will reflect the amount of risk an instrument has. Talking about the behavioral finance perspective of risk, where we say that risk is perceived risk. So perceived risk or risk perception has been defined and categorized by McCrimmon and Verung 1986 in three groups. So perceived risk can be defined as the amount of loss we are ready to take, possibility of loss, and the exposure to loss. Oslin 2001 has also defined risk perception is that risk is multi-attribute. There are social and cultural factors like trust, democracy, fairness, which affects individual perception about the risk, and risk always has a emotional side. That is what Oslin has said. Selto and Cooper described perceived or subjective risk as the perception of attributes of objective risk, wherein perception may be imperfect and which can be affected by various other attributes of choice, like our background, personal understanding, professional experience, our judgment, impression, our personality, opinions. All of these things also affect our subjectivity of risk, how we look at the objective risk, which is defined by various calculations or which is defined mathematically. How do we perceive that risk as for ourselves? So different people can have different perception towards risk. What is a major risk for me can be a minor risk for somebody else. Sitkin and Wellingard 1995 defined risk perception as individuals' assessment of how risky a particular situation is in terms of probabilistic estimates of the degree of situational uncertainty, how controllable that uncertainty is, and how much we are confident about those estimates. Behavioral finance influences investor perception of risk. Now, risk is dependent upon, let's say, our the capacity or the ability to take risk. Do we have the ability to take risk? So, everybody can have different ability to take risk, and then comes what is our risk attitude. Our risk attitude is defined by our mental and cognitive processes or the heuristics which we have in our mind, which affects or which has formed our personality over years. So, they affect the perceived risk or the subjective aspect of risk. So, each one of us can have different experiences of life, can go through different personality, can have different personality traits, can be in different kind of professions, which can affect our risk taking capacity as well as will also affect our risk attitude. So, one such influencer is heuristics. So, heuristics are those shortcuts which are useful for taking quick decisions, and these are developed over time by experience and by sharing our knowledge of past events. One such important heuristic is availability heuristic, which is used to judge the likelihood or frequency of an event or occurrence, and this probability assessment is main aspect of risk assessment in decision making. So, availability heuristic is that whenever we have to take a decision, some information which is quickly available to us or whichever comes to our mind first, so we try to assume it as correct and we try to take our decision based on that. So, that is availability heuristics. So, heuristics are basically all these mental shortcuts which we use in our routine life, which the system one part of our brain is going to use, which is intuitive brain, the unconscious subconscious brain, which quickly takes decisions. So, all of these heuristics, there are many other heuristics which we will discuss in some other session, which affects. Apart from that, then there are other behavioral characteristics or attributes which affect our risk assessment or our risk attitude, like overconfidence. Overconfident person usually becomes inattentive with respect to the cognitive processes of decision making, and this can sometimes may lead to taking wrong decisions. Loss aversion, as a concept we have already discussed about loss aversion, that people avoid losses rather than achieving gains. So, avoidance of loss is main aspect of their decision making. So, that is why this can also affect the risk attitude of a person. Representativeness bias, it is a belief that an event resembles another event in the same class and its effect reflects the causes which produced it. So, people tend to make holistic conclusions and take decisions based on similarity of items and draw inferences based on that. So, if we are going through an event and we are uncertain about the outcome, but we have already seen similar event where we can represent our thought process with that similar thing also happened last year to me and this was the outcome. So, I assume that this will be the outcome this year also. So, let me not invest my money in this particular alternative, or let me invest my money in this particular alternative. Framing bias also affects our risk attitude. Framing means the way something is being defined to us or reflected to us. So, the way things are framed or explained to us do affect our decision making. So, how much, with what level of rationality, with what level of seriousness we would look at a particular aspect will define that how much we are going to assume the perceived risk in that particular decision. There are other behavioral biases like anchoring bias. Anchoring means using some belief, trend, information as a link and use it as a reference point for any upcoming decision. For example, if my experience with a particular company when I invested money last year in that company was not very good. So that becomes an anchor with me. Now, if an investment let's say advisor will advise me to buy the share of that similar company which I bought last year where the experience was not good, so I already have a decision, or I already have an experience with that company in mind, and I may say that I don't want to invest in this particular company because that company has already given me losses. So I have an anchor based on which I am taking my current decision that I don't want to invest money in that particular company. Familiarity bias, it describes to denote a degree of knowledge and experience he has with respect to a task or object. So if you are familiar doing a particular task, right, if somebody is a mountaineer and he knows how to, he has already climbed various mountains, so another task which comes up to him that there is a tracking mountaineering where he has to do a tracking, he will not consider it as a risk, or his risk attitude towards it will be less risky. But for a person who has never done tracking or mountaineering, if he is asked to track a mountain or has to climb a mountain, for him it will be a risky venture. So whether we have done something, we have experienced, we have gone through a particular event or a decision previously, that will also affect how we are going to respond to that particular situation today, or how we will perceive the risk related to it. Then level of control also defines or also affects our risk attitude in two ways. One is locus of control. It shows the control one perceives over his behavior and outcomes of a situation. So there can be two locus of control, external locus of control and internal locus of control. External locus of control is where we put the onus of whatever happens or the decision or the outcomes on somebody else, that whatever outcome will come, whether it will be positive or negative, it will be because of something else. It will be because of market situations, it will be because of government policies, it will be because of company X policy or company Y's policies. So the locus of control or the outcome is affected by other factors rather than my internal factors. While somebody who has internal locus of control will be little bit more risk let's say averse, because everything whatever happens, if the outcome is favorable or unfavorable, they would put the onus of that outcome on themselves, that my decision was wrong, that is why it happened to me, or that is why I have incurred the losses or I have incurred the profits. Second type of control is perceived control. It is the illusion of control. It is a belief that one has that he is able to control the desired outcome. So it is that I have that illusion, or I perceive that I am controlling the outcome. But usually in investments, the outcome is not controlled by me. It is affected by various market factors, it is affected by other decision making aspect or other company related factor, business risk, financial risk, other aspects which affect. Then there is another important attribute related to the decision, the risk attitude, that is the role of affect or the feelings. What is my mood today? What is my reaction to a particular event? How much I am worried, whether I am very happy or I am sad, I am in a happy mood, I am in a sad mood, that affects how much risk I am going to take today. If somebody is very happy, maybe he is ready to take more risk today as compared to the day which is not a very good day for him. Now, risk attitude is perception of a person towards anything which defines his or her attitude towards that thing. It is a way of thinking or feeling which forms their opinion and then determines the attitude of that person. A person can have positive or negative attitude, and this attitude can also differ from person to person. One person can have positive attitude while another one can have negative attitude towards the same situation, and the attitude of a person will define his decision. So risk attitude of a person is defined as his or her perception or intention about a situation being risky or not, and take actions accordingly. A given situation can be risky if we do not have the required information about it, and it is the attitude of the person whether he will become risk taker or a risk averse. A person is a risk taker or a risk seeker if they know the riskiness of a security. If risk is objectively defined to us, then a person may be ready to take more risk in that situation and still invest due to their level of confidence, knowledge and expectation of high returns. As we know that high risk will mean high returns, but it may not always be true. Sometimes taking high risk can lead to losing more money. Then there are another category of risk attitude, defines risk attitude, that is risk-averse personalities. They are very careful and judgmental about their investments. They do not want to take a risk for the benefit of some extra bucks or some extra rate of interest. They invest in securities where they expect constant and fixed returns. There are numerous models which recognize this approach of investor towards risk. According to Etty Baronoff, Patrick L. Brockett and Yeduha Kenne, there are three types of risk attitude that prevail in our lives. One is risk averse, risk seeker and risk neutral. Risk averse are those people who do not take risk. They prefer to invest in those securities where they have certainty in their investment, where their risk is minimized to zero. So, they will invest in fixed deposit, bank deposits or other government securities where the risk is minimum. Then there are risk seekers. These are those kind of people who want to maximize their returns on investment, and they invest their money in high risky investment instruments. And they would invest in equity shares, they would invest in mutual funds, they would invest in bonds of companies, they would invest in derivative market or all risky ventures. As a venture capitalist in the crowdfunding, they will become crowdfunding investors, they will invest in new risky ventures. So, all of them are risk seekers. Third category of individuals are risk neutral. They are those people who are said to be where their risk preferences lies somewhere between being a risk averse or a risk seeker. So, they are taking risk sometimes, they are not taking risk other times. Then Barclays also have defined risk attitude in two perspectives. One is the ability or capacity to take risk. It depends upon your financial objective, your wealth. If you have more wealth, you have long term investment goal, maybe you are ready to take more risk, and you have the higher ability to take losses. But if you have less wealth and your objective is short term, or you want short investment returns, then maybe your capacity to take risk or ability to take risk will be less. So, if you are financially weak, then you will not be open for risk and will be afraid to put your money in risky avenues. Your willingness to take risk, this is based on mental ability of a person. Some people are so afraid to take risk that they can have sleepless night because of stress of loss. So, such people, those who are risk averse, should not bother to take a risk in their life. Another way of classifying risk profile is that no risk. These are those investors who simply say no to any investment risk which they have to take, because they want to preserve their wealth. They are usually those people who are retired and who want to lead a peaceful life, do not want to waste their money by losing money in the stock market or by earning losses. Then there are investors who are ready to take low risk. So, they are low risk investors. They want to achieve fair returns from growth perspective, but also want their money to be protective for any fall in the market. There is a possibility that they may have little or no experience, but are interested in earning returns which are more than the cash deposits. They have to understand that they need to invest money in low to medium risk in stocks for next 5 years. Then there are medium risk investors. These investors need to understand that they can earn medium to high returns if they take medium risk. They usually have some experience and exposure to investment risk and understand their potential returns. They should invest in opportunities which involve investment for long term with medium term risk. Then there are high risky investors. These are experienced investors who take high risk to get high returns, and they are ready to take an exposure of maybe 100% in the stock market to get high returns. Now, what are the factors which affect risk attitude? How much is the investor ability to bear the loss? So, the ability to bear the loss will define your risk attitude, whether in a particular situation you will be a risk seeker or a risk averse or a risk neutral. Do you have emergency reserve fund? So, the money which you are investing, what type of money it is? Is it your emergency reserve fund, or you have spare money which you are investing now? So, depending upon what is the type of nature of investment you are going to make, the amount of money you are going to invest, what is that the type of that money will define your risk attitude, time horizon of investment. If the investment is available for a longer period of time, maybe a person risk attitude is risk taker rather than a risk averse. Age and health condition, whether if you are younger in age, your risk attitude is of a risk seeker rather than of a risk averse. Older people have risk averse attitude because they do not want to lose their money which they have saved after retire for post retirement scenario. What is your investment target? One should have investment target to achieve, like whether you want to require money for a particular goal to be fulfilled, maybe for example for higher education, for your higher education or your kids higher education, or paying off a particular liability like a home loan or marriage of your kids. So, what is the purpose for which you are saving, you are investing money? That also define how much risk you will be ready to take. Source of investment fund, from where the money you are investing from, what is the source of that money, whether it is a capital gain. If it is a capital gain, your risk taking attitude would be risk seeker, you will be ready to take more risk, as compared to if it is your hard earned money or it is borrowed fund where you don't want to take more risk. Percentage of portfolio which you want to invest in that particular alternative will also define that whether you will have a high risk attitude or a low risk attitude. There are other factors which can influence the risk attitude of an investor, like familiarity. If you are familiar, let's say you are familiar to investing money in the stock market, then maybe your risk attitude would be of a risk taker rather than a risk averse. But if you are not familiar to a particular investment alternative for the first time, maybe you will be ready to take less risk in that investment alternative. Media attention. So, how much media attention that particular investment opportunity is getting. Something which is getting a lot of media attention, we tend to assume that that particular investment is credible or is very safe or is less risky, although it offers huge amount of risk. So, how much people are talking about it, how much attention it is getting in media, in social media nowadays, or at various levels, that also define. Your personal and societal factors also define how much risk you are ready to take. Whether you trust a particular investment alternative or an advisor, that also will define what will be your risk attitude. Your voluntariness of investing money. If you are investing money voluntarily, then maybe your risk attitude would be taking more risk. If it is forced investment, then maybe you will be not taking more risk. What benefit you are seeing from investing money? You want to earn, you see high profits coming to you from the risky investment, that will automatically generate a feeling of taking high risk. What is your knowledge as related to that subject, related to that investment or that subject which we are, the decision you are going to take, that will also define your risk attitude. Emotional intelligence has very big impact on your risk attitude. Emotional intelligence is the capacity of individuals to recognize self and other emotions, to discriminate between feelings and label them appropriately. By doing this, they will be able to judge that a person, so you are able to judge situations and person better and take actions accordingly. So, emotional intelligence has an important role to play in risk management. It affects the investor as well as it affects the fund managers who are going to give suggestions to others for taking decisions. So, most of the investors are emotionals. We are guided by cognitive factors and heuristics while taking decisions. So, if they are considered well in advance by your investment advisor, then maybe right kind of decisions of right kind of products can be defined. So, apart from that, there are some implications for the investment managers or the investment advisors, while keeping in mind that the risk attitude of their investment. So, how do they how should they suggest recommendations to their the investors whose money they are going to invest. So, first thing should be that there should be a detailed analysis of all the components of the investment. Assessment of risk attitude of the investor should be done through some risk assessment scale or investment profiling. Then one should invest in the company which is familiar to you. Diversification of portfolio is very, very important to avoid all sort of risk. It helps you avoid the risk. The unsystematic risk of part of the risk is gone. One must invest in keeping in mind the investment goals of the investment, the individual. Then expert advice can also be taken at keeping in view the appropriate level of risk. So, this help us define the risk attitude. So, basically an investment advisor or as an individual, what we should do to manage our risk well, that one should understand that what is our capacity to take risk, how much is our ability to take risk. Then one should try to identify that what is your risk attitude, keeping in view your emotional and cognitive factors which affect you at any point of time, that what is your risk attitude, whether you want to take more risk or less risk. Simultaneously, some risk profiling should be done related to your present scenario. What is the risk, the riskiness of the instruments which are available. Based on that, a decision has to be taken, a decision should be taken while investing your money or while taking any particular decision. So, that is basically, this would cover the risk management, or this would define that how risk has to be managed, so that ultimately in any decision which you take, you achieve success rather than facing failures in life. Thank you very much for your attention.
Thank you for your deep inputs to the lecture. Friends, we believe that your feedbacks are very, very important for us, and if you feel so that you need to write to us your questions too, then do write to us at info.cec@nic.in. We are taking your leave with the promise that we are going to meet again soon and would be discussing more. Till then, take care. Goodbye. Thank you, ma'am. Thank you once again.
Thank you.